To get started, I would recommend that you get a completely free Gold IRA guide that is written by the best and most trusted Gold IRA company that I have found after over 20 years as an expert independent gold researcher. This free Gold IRA guide will explain everything you need to know and will also answer any questions you may have about Gold IRAs. This is the best guide I have seen in my lifetime as an expert independent gold researcher with more than 20 years of experience, and this is the best guide available anywhere, in my opinion. Also, when you get this free Gold IRA guide, you will get free access to the top Gold IRA experts who will provide you with personalized support and help over the phone, and they will answer any questions you may have. To get this top free Gold IRA guide, simply go to the link that is in the episode show notes or go to the link that is in the episode description. So again, to get this top free Gold IRA guide, simply go to the link that is in the episode show notes or go to the link that is in the episode description. This free guide is really worth getting. Simply go to the link that is in the episode show notes or go to the link that is in the episode description. Also, this audiobook is not financial, investment, or tax advice. For financial, investment, or tax advice, consult a financial, investment, or tax advisor and take full responsibility for any decision you make. Okay, let's start the audiobook. Build Retirement Wealth, Gold IRA, Stocks, ETFs, or Bitcoin. Navigating Your Golden Years Roadmap Retirement. The very word conjures images of sun-drenched beaches, leisurely mornings, and pursuing passions long sidelined by the daily grind. It's the financial summit we all strive to reach, a time of freedom and security earned through years of diligent saving and strategic investing. But in today's complex and ever-shifting financial landscape, charting the optimal course to retirement wealth can feel less like a leisurely cruise and more like navigating treacherous waters. The traditional retirement planning landscape, once dominated by pensions and predictable savings accounts, has drastically evolved. We now face a dizzying array of investment vehicles vying for our attention and hard-earned dollars: stocks, bonds, mutual funds, real estate, and increasingly popular yet often debated options like exchange-traded funds, ETFs, cryptocurrencies like Bitcoin, and the timeless allure of precious metals, particularly Gold IRAs. This comprehensive audiobook dives deep into the crucial question facing every retirement saver. Where should you allocate your retirement funds to build lasting wealth? We'll meticulously dissect 4 key contenders: Gold IRAs, stocks, ETFs, and Bitcoin, examining their individual strengths, weaknesses, risks, and rewards, all within the specific context of retirement planning. While we aim for a balanced and informative approach to each asset class, we will particularly illuminate the compelling case for Gold IRAs as a cornerstone of a robust and resilient retirement portfolio, especially in an era of economic uncertainty and evolving global dynamics. Buckle up, retirement dreamers. Let's embark on a detailed journey to explore these investment avenues and equip you with the knowledge to make informed decisions that pave your path to a financially secure and golden retirement. Understanding the retirement landscape, why diversification is key. Before we delve into the specifics of each investment option, it's crucial to establish a foundational principle of sound retirement planning: diversification. The adage, "Don't put all your eggs in one basket," rings especially true when it comes to securing your future. Retirement is a long-term game, spanning decades. Economic cycles ebb and flow, markets fluctuate, and unforeseen events can impact even the most seemingly stable investments. Diversification is the strategic allocation of your investments across various asset classes. This approach aims to mitigate risk. When one asset class underperforms due to market downturns or economic shocks, others may hold steady or even thrive, cushioning your overall portfolio and preserving your capital. A well-diversified portfolio isn't about chasing the highest returns in any single sector. It's about building a resilient and balanced foundation that can weather storms and consistently grow over time. The question isn't necessarily about choosing one of these options, Gold IRA, stocks, ETFs, or Bitcoin exclusively. Instead, the smarter and more strategic approach lies in understanding how each asset class can play a role within a diversified retirement portfolio. The optimal allocation will depend on your individual risk tolerance, investment timeline, how far away you are from retirement, and financial goals. Stocks, the engine of growth, but with volatility. For decades, stocks have been considered the cornerstone of long-term growth. Owning shares in publicly traded companies grants you a sliver of ownership and potential participation in their profits and expansion. Historically, stocks have delivered impressive returns over extended periods, outperforming many other asset classes and offering the potential for significant capital appreciation. The allure of stocks: high growth potential. Well-selected stocks, especially those of companies in growing sectors or innovative industries, can experience substantial price appreciation, leading to significant returns over time. This growth potential is crucial for building a substantial retirement nest egg, particularly for younger investors with a longer time horizon. Dividends. Many established companies distribute a portion of their profits to shareholders in the form of dividends. These regular payments provide a steady stream of income, which can be reinvested for further growth or used as supplemental income in retirement. Liquidity. Stocks traded on major exchanges are generally highly liquid. You can easily buy and sell shares, providing access to your funds when needed, though selling during market downturns can lock in losses. Participating in economic growth. Investing in stocks allows you to participate directly in the growth of the economy and the success of individual companies. It's a way to be part of innovation and progress. The realities of stock market risks. Volatility. The stock market is inherently volatile. Prices can fluctuate significantly based on a multitude of factors: economic news, company performance, geopolitical events, investor sentiment, and more. This volatility can be unnerving, especially for those nearing retirement who are less comfortable with large swings in their portfolio value. Market risk, systematic risk. This is the risk that the entire stock market will decline, affecting virtually all stocks to some degree. Economic recessions, financial crises, and major global events can trigger market-wide downturns, leading to significant losses even in well-diversified stock portfolios. Company-specific risk, unsystematic risk. This risk pertains to the specific performance of an individual company. Poor management, declining profits, industry disruption, or scandals can cause a company's stock price to plummet, regardless of overall market conditions. Emotional investing. The emotional roller coaster of the stock market can lead to poor investment decisions. Fear and greed can drive investors to buy high during market peaks and sell low during market dips, undermining long-term growth strategies. Time horizon dependency. While stocks have historically performed well over long periods, short-term returns can be unpredictable and even negative. Stocks are generally considered a long-term investment, and their suitability for retirement depends heavily on your time horizon. Someone closer to retirement may need to reduce their stock allocation compared to someone decades away. Stocks in retirement portfolios. Stocks are often considered an essential component of retirement portfolios, especially for younger investors and those with a higher risk tolerance. However, the allocation to stocks should be carefully considered and adjusted as you approach retirement. As your time horizon shrinks, it's generally prudent to gradually reduce your stock allocation and increase exposure to less volatile assets to protect your accumulated wealth from late-stage market downturns. ETFs, exchange-traded funds, diversification at your fingertips, but still market-linked exchange-traded funds, ETFs, have surged in popularity in recent decades, offering a convenient and often cost-effective way to achieve diversification within a single investment vehicle. An ETF is essentially a basket of securities, stocks, bonds, commodities, etc., that tracks a specific index, sector, or investment strategy. ETFs trade on stock exchanges like individual stocks, providing liquidity and flexibility. The advantages of ETFs. Instant diversification. ETFs provide instant diversification by holding a collection of assets, reducing company-specific risk and sector-specific risk. This pre-built diversification is a major advantage, especially for investors who are new to the market or prefer a simpler approach to portfolio construction. Lower expense ratios. ETFs, particularly passively managed index ETFs, typically have lower expense ratios compared to actively managed mutual funds. These lower fees can significantly impact long-term returns, as even small differences in fees compound over decades. Transparency. ETFs are generally very transparent. You can easily see the underlying holdings of an ETF, allowing you to understand exactly what you are investing in. Liquidity and trading flexibility. ETFs trade on exchanges throughout the day, offering intraday liquidity and the ability to buy or sell at any time during market hours, similar to stocks. Variety and specialization. The ETF universe is vast and diverse, offering ETFs that track broad market indexes, like the S&P 500, specific sectors, technology, healthcare, energy, geographic regions, bond markets, commodities, and even niche investment strategies. This variety allows investors to tailor their ETF selections to their specific investment goals and risk tolerance. The limitations and risks of ETFs. Market risk. Systematic risk. Like stocks, ETFs that track broad market indexes are still subject to market risk. If the overall market declines, the value of these ETFs will also likely fall. While diversification within an ETF mitigates some risk, it doesn't eliminate systematic market risk. Tracking error. ETFs aim to track the performance of their underlying index. However, there can be some tracking error, meaning the ETF's actual performance may slightly deviate from the index's performance due to factors like fund expenses, trading costs, and sampling techniques, for ETFs that don't hold every security in the index. Sector or niche concentration. While broad market ETFs offer diversification, sector-specific or niche ETFs can be more concentrated and therefore riskier. Investing solely in a technology ETF, for example, exposes you to sector-specific risks and potential downturns in the technology industry. Overlapping holdings. If you invest in multiple ETFs, especially those tracking similar indexes or sectors, you may inadvertently create overlapping holdings and reduce your overall diversification benefits. Careful portfolio construction is still important even with ETFs. Not a safe haven in crises. While ETFs offer diversification across markets, they are still inherently tied to market performance. In times of severe economic crises or market crashes, the value of most ETFs, especially those linked to equities, can decline significantly. They are not typically considered safe haven assets that perform well during market turmoil. ETFs in retirement portfolios. ETFs are highly valuable tools for retirement portfolio construction. They offer diversification, cost-effectiveness, and flexibility, making them excellent building blocks. A well-diversified retirement portfolio can utilize ETFs to gain broad market exposure to stocks and bonds, using total market ETFs or diversified index ETFs, and potentially to target specific sectors or investment styles to align with your risk tolerance and investment goals. However, it's crucial to remember that ETFs tied to market performance are still subject to market risk and may not offer the level of downside protection needed during periods of heightened economic uncertainty. Bitcoin, disruptive potential, high volatility, and retirement risk. Bitcoin, the pioneering cryptocurrency, has captured the imagination of investors worldwide. Proponents tout its disruptive potential, decentralization, and potential for high returns. However, Bitcoin remains a highly volatile and speculative asset, and its suitability for retirement portfolios is a subject of intense debate. The lure of Bitcoin, high growth potential. Historically, Bitcoin has demonstrated periods of explosive price growth, generating significant returns for early adopters. The potential for continued growth, driven by increasing adoption and limited supply, remains a major draw for some investors. Decentralization and inflation hedge argument. Bitcoin is decentralized, meaning it's not controlled by any central bank or government. Proponents argue this makes it a hedge against inflation and currency debasement, as its supply is limited to 21 million coins. In times of economic uncertainty and concerns about inflation, this narrative appeals to some investors. Global and 24/7 trading. Bitcoin trades globally and 24/7, unlike traditional markets with limited trading hours. This accessibility and continuous trading can be attractive to some investors. Technological innovation. Investing in Bitcoin is seen by some as investing in a revolutionary technology with the potential to transform finance and other industries. The significant risks and challenges of Bitcoin. Extreme volatility. Bitcoin is notoriously volatile. Its price can swing dramatically in short periods based on market sentiment, news events, regulatory developments, and speculative trading. This extreme volatility makes it a highly risky asset, particularly for retirement savings where capital preservation is paramount. Speculative asset. Bitcoin's value is largely driven by speculation and investor sentiment. It lacks the underlying fundamentals of traditional assets like stocks, company earnings, or bonds interest payments. Its value is heavily dependent on continued demand and belief in its future potential. Regulatory uncertainty. The regulatory landscape for cryptocurrencies is still evolving and varies significantly across jurisdictions. Uncertainty about future regulations and potential government crackdowns poses a significant risk to Bitcoin and the broader crypto market. Security risks and scams. The cryptocurrency space is rife with security risks, including hacking, theft, and scams. Storing Bitcoin securely requires technical knowledge and vigilance. Loss of private keys can result in permanent loss of Bitcoin holdings. Lack of long-term track record. Bitcoin is a relatively new asset class compared to stocks, bonds, and precious metals. It lacks a long-term track record through various economic cycles and market conditions. Its performance during periods of prolonged economic downturn or high inflation is still largely untested. Energy consumption and environmental concerns. Bitcoin mining, the process of verifying transactions and creating new coins, is energy intensive. Concerns about the environmental impact of Bitcoin mining are growing and could lead to increased regulation or decreased adoption. Limited utility as a store of value, currently. While proponents argue for Bitcoin as a store of value, its extreme volatility undermines its reliability as a stable store of wealth, especially for retirement savings that require predictability and security. Bitcoin in retirement portfolios? A highly cautious approach. Given the significant risks and volatility associated with Bitcoin, it is generally not recommended as a core holding in a retirement portfolio, especially for individuals nearing retirement or with a low risk tolerance. For younger investors with a high risk tolerance and a very long time horizon, a very small and speculative allocation to Bitcoin might be considered as a high risk, high reward moonshot component. However, such an allocation should be extremely limited, perhaps a single-digit percentage of the portfolio, and investors must be fully aware of the potential for substantial losses. For retirement savers seeking stability, security, and predictable growth for their golden years, Bitcoin's risk profile and speculative nature make it a highly questionable choice. The peace of mind and capital preservation critical for retirement are often undermined by the inherent uncertainty and volatility of Bitcoin. Gold IRA, the timeless safe haven and portfolio anchor for retirement. Now, let's turn our attention to a time-tested and often overlooked asset class that can play a crucial role in building robust and secure retirement wealth: gold IRAs. While stocks, ETFs, and even Bitcoin are increasingly discussed, the strategic importance of gold, particularly within a retirement context, deserves careful consideration, especially in today's economic environment. A gold IRA, Gold Individual Retirement Account, is a self-directed IRA that allows you to hold physical gold and other precious metals like silver, platinum, and palladium within a tax-advantaged retirement account. This offers the benefits of owning physical gold, traditionally seen as a store of value and safe haven asset, within the tax-sheltered environment of an IRA, allowing for potential tax-deferred or tax-free growth depending on the type of IRA, traditional or Roth Gold IRA. Why gold IRAs stand out for retirement security? Safe haven asset and stability in uncertainty. Gold has historically acted as a safe haven asset during times of economic turmoil, market volatility, geopolitical instability, and currency crises. When stock markets decline and other asset classes falter, gold often maintains its value or even appreciates, acting as a portfolio diversifier and a buffer against losses. This stability is particularly crucial for retirement savings, which are meant to provide a secure financial foundation during your later years. Inflation hedge. Gold has a long history of acting as an inflation hedge. When inflation erodes the purchasing power of fiat currencies, like the US dollar, gold's value tends to rise. This is because gold is a tangible asset with limited supply, and its value is not directly tied to government monetary policies or the performance of any particular economy. In an environment of rising inflation or concerns about future inflation, gold can help preserve the real value of your retirement savings. Diversification. Beyond traditional markets, gold has a low or even negative correlation with stocks and bonds. This means that when stock and bond markets decline, gold often performs differently, providing true diversification and reducing overall portfolio volatility. This uncorrelated nature makes gold a valuable addition to a retirement portfolio, enhancing its resilience and reducing its vulnerability to market downturns. Tangible asset and store of value. Unlike stocks, ETFs, or Bitcoin, which are essentially digital or paper-based assets, gold is a tangible physical asset. This tangibility can provide psychological comfort and a sense of security, especially during times of financial uncertainty. Gold has intrinsic value and has been recognized as a store of value for thousands of years across cultures and civilizations. Tax-advantaged growth within an IRA. A gold IRA offers the tax advantages inherent to IRAs. In a traditional gold IRA, your contributions may be tax-deductible and your earnings grow tax-deferred. In a Roth Gold IRA, contributions are made with after-tax dollars, but qualified withdrawals in retirement are tax-free. This tax-advantaged growth allows your gold holdings to potentially grow more effectively within the retirement account. Physical ownership, indirect. While you don't physically hold the gold in your possession in a gold IRA, you own physical gold, bullion or coins, that is held in your name by a secure, IRS-approved depository. This indirect ownership provides the benefits of physical gold ownership within the regulated and tax-compliant framework of an IRA. Potential long-term appreciation. While gold may not experience the explosive growth potential of some stocks or cryptocurrencies, it has historically demonstrated long-term appreciation, particularly during periods of economic uncertainty, inflation, or geopolitical instability. Gold supply is limited, and demand is driven by various factors, including investment demand, industrial use, and jewelry demand. Considerations and nuances of gold IRAs. Market fluctuations, gold price volatility. While gold is considered less volatile than stocks or Bitcoin, the price of gold can still fluctuate. Economic news, interest rate changes, and global events can influence gold prices. However, gold's volatility is generally lower than that of equities and significantly lower than that of cryptocurrencies. Choosing the right gold IRA provider. Selecting a reputable and experienced gold IRA provider is crucial. Research different companies, compare fees, understand their storage options, and ensure they comply with IRS regulations for gold IRAs. Gold IRAs in retirement portfolios, a strategic anchor for stability and preservation. For retirement savers seeking to build a resilient and diversified portfolio with a strong emphasis on capital preservation and long-term security, gold IRAs offer a compelling and strategic option. Gold can act as a portfolio anchor, providing stability during market downturns, hedging against inflation, and diversifying beyond traditional market-linked assets. Conclusion: charting your course to a golden retirement with gold. Building secure retirement wealth is a marathon, not a sprint. It requires careful planning, strategic asset allocation, and a long-term perspective. While stocks, ETFs, and even Bitcoin each offer certain characteristics and potential benefits, a gold IRA stands out as a particularly compelling option for retirement savers seeking stability, security, and long-term wealth preservation in an uncertain world. Also, I would recommend that you get a completely free Gold IRA guide that is written by the best and most trusted Gold IRA company that I have found after over 20 years as an expert independent gold researcher. This free Gold IRA guide will explain everything you need to know and will also answer any questions you may have about gold IRAs. This is the best guide I have seen in my lifetime as an expert independent gold researcher with more than 20 years of experience, and this is the best guide available anywhere in my opinion. Also, when you get this free Gold IRA guide, you will get free access to the top Gold IRA experts who will provide you with personalized support and help over the phone, and they will answer any questions you may have. To get this top free Gold IRA guide, simply go to the link that is in the episode show notes, or go to the link that is in the episode description. So again, to get this top free Gold IRA guide, simply go to the link that is in the episode show notes or go to the link that is in the episode description. This free guide is really worth getting. Simply go to the link that is in the episode show notes or go to the link that is in the episode description. Also, this audiobook is not financial, investment, or tax advice. For financial investment or tax advice, consult a financial investment or tax advisor and take full responsibility for any decision you make. This is the end of this audiobook. I hope you enjoyed this and found it valuable. I would really appreciate it if you could please share this with everyone you know. All the best to you.